Hi everybody, this is Gil, and I'm doing a little swing trading basics webinar for all of you. Swing trading has become the obvious approach to this market now that certain people are trying to sell you a product, a swing trading product that supposedly will bring you riches. But swing trading is more involved than that, and I think it would be appropriate for me to talk about how I approach swing trading. And I've been advocating a swing trading approach for the last couple of years or more. In my reports and my websites, and it's been very effective in this market. So before we get going though, a couple of administrative items, the obligatory legal disclaimer, so you can stop the video here and go through this. And also just to review my moving averages so you aren't confused. The magenta moving average you'll see on the charts is a 10-day simple. The green is a 20-day exponential. The blue is a 50-day simple, and the red moving average is a 200-day simple moving average. So let's talk about swing trading. What is it? Well, in simple terms, it's a short-term trading-oriented approach. It's as old as the hills. There's nothing magical about it. It's not a road to instant riches. It is a little more involved than the idea of buying breakouts and then sitting there making 4 or 5 times your money. You're basically looking to take profits of 10 to 30% when you get them. And there are a variety of ways to do this. And you are going to exploit a wide variety of trading setups. So you're not just going to be buying breakouts. There's a lot of other ways to buy stocks. That would include shakeout type maneuvers, undercut and rally type things, white coffee and springs, pocket pivots within the bases, roundabout pocket pivots, etc., etc. And because swing trading is looking to take shorter term profits, you're obviously going to be trading more often. So you're going to have to accept the fact that you will have increased trading frequency, and your activity is going to increase, and you're also going to need to keep tighter risk management. You cannot look to be taking 10 to 20% profits and at the same time have a 7 to 8% stop loss rule as a matter of policy. That's kind of silly. You have to employ tighter risk management because if you're looking at a 10% gain against an 8% loss, the odds are not stacked in your favor, and the risk-reward equation is really working against you in that case. So you need to be able to keep your risk and your stops much tighter. I prefer using a nearby moving average like the 10, 20, or 50-day moving averages or prior area of support as a guide for a stop rather than just a strict, mindless sort of 7-8% stop loss. So you're asking for trouble if you're looking to make smaller profits and keeping a stop loss policy that's about the same percentage or very close to it. We also have to have greater consideration of time value. You want to be optimizing your trades and trying to pick them off at the right time so your capital isn't tied up in something and you're waiting around for something to move. You want to be able to catch inflection points. You want to be able to catch breakouts just before they happen or as they're occurring. And you need to know, in order to accomplish this, you need to know the signs to look for that a move may be imminent. And I'll get into some of this in just a little bit. We can see that over the last year and a half, the NASDAQ composite, along with the other indexes, has been very choppy. You see this big swinging back and forth movement, and a lot of stocks will emulate this sort of movement. You can also see that there are no real breakouts to new highs. Every time the markets come up to a high, it's rolled over again, where the moves occur in between all of that. And as a short seller, as well as a long side trader, some of the breakdowns have been great on the short side. Some of you may remember last August was fantastic, August 2015, where you broke down sharply into the end of the month, and then you've had these bottoms that produce equally sharp upside moves. And a lot of the stocks will look the same as the indexes. In other words, they're moving around in their bases rather than breaking out and moving to new highs. So you have to be able to catch these moves off the bottoms or as stocks are turning up off the lows and are still within these larger chart patterns, because the movements never break out. They just swing back and forth. So we'll get back to this idea of what is time value. In simple terms, it's the profit you make divided by the duration of the trade. So if you're a mathematician, put it in real simple terms, TV equals P over D, time value equals profit over duration. That's for the engineers, but for the rest of us, how much money you make in how much time is basically what time value is. So let's look at a quick example. And this would be trade A, for example, here. 10% profit in 3 days. Okay, not too bad. 10% divided by 3 days equals 3.33. You can pull out your calculator to confirm that if you need to. Trade B, 18% profit in 17 days. And that has a time value of 1.05. So while trade B has a bigger profit, trade A actually has a higher time value. And so you'd like to be able to string together more trade A's relative to trade B's. Now, from a practical perspective, a concrete way of going about this is trying to understand when the inflection points are occurring and when stocks are liable to have big moves. And there are some ways to do this, which I'll get into in just a second. We can look at an illustration of this in a couple of stock examples, the first being Amazon here. So what we can see here is you have this Bible gap up right here, and that occurs on earnings. So the stock takes 1, 2, 3, 4, 5, 6, 9 days to get up 10%. So you get a 10% profit in 10 days. You could sell into that if you want to and then buy back at the 10-day line. But the basic idea here is you get a 10% profit in about 9 days. And we'll look at the second example of LinkedIn. And you can see LinkedIn had a breakout here on earnings and then pulls into the 20-day moving average. So you get this breakout here on a big volume gap type move that sort of closes near the lows, but it drifts into the 20-day line. The volume is drawing up. I like to buy stocks after you see strength and then you see a pullback into the 20-day line. So you'd buy it here and boom, in 3 days you get a 10% move. So that is a 10% profit in 3 days, and that has a very high time value relative to the trade in Amazon. So, you know, if given a choice between the two, I would pick the LinkedIn trade every time. Other aspects of swing trading are that there's less emphasis on fundamentals. I find these days in particular that looking for, 5 quarters of earnings up 20% and sales up 20% or more, or return on equity 16% or blah, 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 all this stuff is kind of pointless, and everybody already knows it. In an age where information is everywhere and everybody knows everything all the time, especially when it's already happened, what everybody knows doesn't give you any edge. So I find fundamentals to be less important when swing trading. And I give you an example. If you look at some of the oil stocks, they've rallied pretty well over the last couple of months since the price of oil bottomed. And all these oil stocks have had playable moves, and I'll show you at least one setup in one oil-related name that is a profitable swing trade. And the companies, these oil companies are losing money. So you don't have to put any emphasis on fundamentals, and I think these days stocks move more on forward-looking stories. Like an example would be Amazon, which people love to complain about its high PE or the fact that it doesn't make any money, but they overlook the fact that over the next 2 or 3 years, the company is going to earn $30 a share, close to that, and that's what it's trading on the basis of the forward-looking story. So you don't need to operate on the basis of fundamentals, but you will rely more on technical analysis. The setups that you're looking at are entirely technically based, and if anything, they may have a thematic driver behind them. So for example, looking at the oil stocks bottoming and turning off of their lows a month or so ago, a couple months ago, when the price of oil bottomed, that would be a thematic factor. Another example would be this wolf pack theme, where I'd look for stocks that are all moving together. A couple of months ago, maybe a little longer than that, off the February lows, you saw the airlines moving together. And when you see a group moving together, that's generally telling you that money is flowing in there. And if you're seeing trade setups among groups of stocks or wolf packs, that reinforces the long side argument for those particular stocks. More recently, I've had cloud stocks have been a wolf pack type of move. So you have to use some creativity in terms of understanding what thematic factors might drive a move in a group of stocks. And in the process also, you would look to exploit a broader variety of trading setups. there's a number of ways to go about skinning the cat in this manner, and you're looking for a lot of different setups besides just plain vanilla breakouts. So types of trading setups that we look for outside of standard issue breakouts, which are one setup, but this is a pretty obvious one, I think. Pocket pivots that allow you to buy within the base. Viable gap ups, especially if they're occurring within the base, can be very viable, but also a viable gap up can occur on a base breakout, and it's not obvious to everybody because it may be extended at that point. So your typical base breakout buyer won't buy more than 5% past the so-called pivot point. And if a viable gap up occurs that takes a stock 10% above the top of the base, then it's supposedly extended. But if you know how to use a viable gap up as a trade setup and you understand the parameters and rules for doing so, you can employ this as a very potent weapon. And then there are the Voodoo setups where I'll see a stock moving tight sideways or pulling back and the volume drives up to extreme levels. The undercut and rally springboard setups where you're undercutting a prior low and you turn back up through that low and bounce back to the upside. You'll see these a lot in this market. I think buying breakouts alone is for the slow animals in the herd. Sorry if you're solely a breakout buyer, but I would encourage you, if you are just a breakout buyer, to expand your horizons and learn about some of these other setups. I think you can improve as a trader, and just overall understanding how price volume action works or can work in varying market environments is very critical to be just improving as a trader overall, and improving your chart eye and your ability to make money in the market. So for that reason, you have to have a broader array of technical tools at your disposal. If you don't, you're just buying breakouts, well, your success rate is going to be lower, and the number of setups that you're going to be able to find is also going to be lower. So let's look at basic base breakouts. Say that 10 times fast. Here we see a Vago. You see the double bottom here, and you have the breakout through the midpoint here, right there, and you pull in for a couple of days, turn around and go out. So that's a base breakout. You could buy that. Now as a swing trader, how are you going to approach this? You're looking to take a profit now as it moves up, say 10-15%. You notice you get, let's say you bought around 140 and it gets up to about 160. Now you're looking at about 14% profit or so, and it's been following the 10-day moving average for some time. Once it violates that could be used as your guide for a quick stop, and then you might look to re-enter if the stock came back up through the 10-day line. But that's a base breakout, and it produces a reasonable gain there, and if you trade it, you can capture that gain. If you sit too long, for those of you who have been watching Vago lately, it broke down and gave up, came all the way back to this breakout point, and so your gains, if you sit there too long, your gains just disappear. Let's look at Smith & Wesson. This is one where it broke out up here and had a nice, say 20% move here up to the 30 level, maybe 15, 16, 17, depending on where you might have sold it. But you see you have the breakout here, and the stock pulls back to the 10-day, so I'd look to buy on that pullback. So notice how it fakes you out, and it goes higher, and you take the gain. Now, that's another breakout, and that works. But notice how you don't get much movement beyond the 30 level there. So your profit's more or less limited to about 15%, maybe a little more. Here's Square. Now, Square is a cup with handle formation. It's a new issue, so thematically, new issues can be hot. You can see the cup with handle right there. We actually bought it at 12.05. That's when I recommended buying it at that point, because you're seeing volume drying up here as it was holding tight along the 10-day. That's the Voodoo setup. And it breaks out and pulls back, so it gives you two chances to buy. If you bought here, you see it run up, it comes back in, you buy it at the 10-day line, and boom, in a matter of 5 days, you get this, do the math on this one, you're going from about 12.31, say, to 12.30, 12.20 up to 16. So you're getting 4 points out of that. That's about a 30% move, 30-something% move. That's very nice. Now, keep in mind that Square didn't have earnings, I don't believe. yet it had a very nice price move, and that's one of the best plays that we've had all year in terms of buying a breakout. So, but it does show you that you can buy breakouts, but the moves are measured, and you notice it breaks down here, and that's pretty much all she wrote. Now, here's Hawaiian Holdings. This one broke out up here. You can see you got some volume in here as it's coming up. And it runs up. Now here's another example where you followed the 10-day moving average, but once you start to falter and break down, you could be out of the stock and bagging your profit. And you're going to make about a 10-15% gain there. But, you know, you see these breakouts and you get 10-15% moves. Now, you can get on board earlier by using the pocket pivot advantage, as I call it. So let's look at Smith & Wesson. Remember, we talked about this as a breakout up here, and it broke out. It has a nice move right there, but you could actually bought it here on the pocket pivot. So you'd be buying it as it's rounding out the bottom of the base and buying this pocket pivot and getting in early. So you're buying it within the base structure, and well before you either get this breakout, you could call that a little cup with handle type breakout, but you're in before then, and you're definitely in before here. So you're getting much more, capturing much more of this trend, okay? So that's the pocket pivot advantage at work for you. Let's look at another one. I think we can go back to Hawaiian Holdings. Yeah, Hawaiian Holdings, rather than waiting for the breakout up here, so instead of waiting for it to break out through here, you can buy this pocket pivot right here, and that gets you in about 4 or 5 points earlier. So, you know, about 10% earlier, and then you capture this trend. Notice how it holds along the 10-day moving average. It actually never violates the 10-day moving average. And you can read our book, Trade Like an O'Neill Disciple, to understand how moving average violations work. But it never violates the 10-day moving average, and it continuously holds a 20-day line. So you could have used that as your stop to take your profit on that on the way up. But that's a good example of the pocket pivot advantage. Energy Recovery. Now, here's a little stock, $6 stock, has a pocket pivot as it's building this base. And you can see here, you're trying to round out this base here. And you're still well off the highs, okay? But you're buying it in here, and you get a 50% move higher. And notice how it holds along the 10-day line all the way up. And now it violates up here, so you could be out, you bag your profit. That's a very nice move. And if you're buying it around 6.5, it's actually a double, believe it or not. And of course, this is an example of a stock that does not fit the so-called can slim rules, where you need to have earnings and price has to be over 8. I think earnings here there was a little bit of earnings here, a couple of cents, but there was a thematic driver here in that these guys create pumps or make pumps for companies like Halliburton, for the fracking industry, and also pumps that are used in desalination plants. So there's a thematic thing going on there, and it coincided with the bottom in oil as well. And this stock had a nice big move. It's currently basing again. I think it's somewhere around 10, 11. Might take a look at that one. It may set up again and go, but you can see the pocket pivot advantage gets you in way before the breakout, even though you would have done pretty well with the breakout. And you can see how the 10-day line works like a champ here in terms of keeping you in the stock until it finally gives way. Let's look at the next set of setups, pocket pivot variants, roundabout pocket pivots, which are essentially pocket pivots like the ERI that are coming around bases, and then the lows of bases, and then bottom fishing pocket pivots. The difference between the two is a bottom fishing pocket pivot will occur later in the pattern. So, for example, here's Mobileye, and you can see this thing broke down, and it flashes this big volume pocket pivot coming up through the 10 and the 20-day, and that's viable, and the stock heads higher from there. So that's a bottom fishing type pocket pivot. This is more of a roundabout type pocket pivot where the stock's already come up off the low, so it's trying to round out the new base, and you have a pocket pivot on a supporting day at the 50-day moving average. You could buy it there. Stock moves higher. Now notice how it tends to hold the 20-day pretty well, and then when it breaks, that's pretty much all she wrote. And so again, you get maybe 15% profit at the peak. Notice how when it's trying to break out and getting up to the left side peak of the base over here, to this left side peak, when it's getting up here, it's getting a little long in the tooth, but you can capture that move, and that's not too bad in this market. So 10-15% gains if you can get them in this market or more, then you are doing reasonably well, given that that's basically what the market's going to give you. Let's look at some others. Silica Holdings is an oil-related name. Now, in February, a lot of these bottomed with the market, and then as the price of oil started to turn, you started to see some pocket pivots. So here's a pocket pivot. If you go through here, you may find other pocket pivots in the pattern. Let's take a look here. I think this looks like a pocket pivot here, which would have been right at the 10-day line here, I believe. No, I'm sorry, right here. And then you see another pocket pivot here, and it's continued higher. I think today it got over 28. As the price of oil has gotten up to $50. But there's a thematic basis here for this play here, and you see the bottom fishing a roundabout pocket pivot as it's trying to round out the lows of its pattern. Energy recovery, again, this is also an example of a roundabout or bottom fishing pocket pivot. I already discussed that. Bible gap ups, pretty straightforward. Here's one Bible gap up in NVIDIA coming off the lows. That's a bottom fishing Bible gap up, but it holds a 50-day line, and you notice how if you bought it, which you could have, and you could use the 50-day line as your guide for a stop, maybe with another 1% once it was able to clamber back above it, and as it's moving up, it holds a 20-day line, and then back to the 50-day, and then you get another gap up here, and that was buyable. And the basic rule for buying a buyable gap up is that you're going to use the low, the intraday low of the gap up day as your selling guide. So you can buy it on that day and use the low of the day as your stop, and then you catch this nice move. And this is, if you're buying this here around 30, say 39, and you're getting up to 45, I think this thing got as high as 46, 47 recently, you're getting much better than a 10% move there, so close to 15. But you can see how this is, and this might be considered extended from the breakout point. Electronic Arts was a similar situation where it's a viable gap up. It actually opens here and then runs up, and I think today this stock was running around 77, 78. But you can see if you bought it on the viable gap up day, and I actually did blog to my members that it was probably viable that day, you've gotten a nice 10% move out of it over the last couple, 3 weeks. So not exceptional time value, but it is showing you how this looks extended, but it's not really. It's quite viable using the typical rules for playing a viable gap up. Here's the Voodoo principle. Now, Voodoo is a cute term, but it basically comes from the idea of a volume dry up, which you can then distill down to the acronym VDU. And then if you want to get cute, with inspiration from my friend Ian Woodward, who passed away a little over a week ago, and he was famous for coming up with these colorful names for different technical setups and phenomenon. You turn that into Voodoo, so you can sort of see how that evolves. If you can't, then you're probably totally left-brained. But here's a great example, and this is one I blogged to my members about. Here's the stock holding tight, Weibo, which is the Chinese Twitter, holding tight right at the 10-day and the 20-day moving average. Volume is the lightest in the pattern or in this base, so it's drying up in the extreme. That's an entry point. And this stock has had great time value because it was buyable around 23.50 or so, maybe a little lower. And I think today it hit 29, got above 29, so that's a good 20-30% move in just a few days, and so that's exceptional time value. But that's a Voodoo type setup where you're looking to buy this kind of volume dry up in a tight formation. Now, Voodoo also can occur on a pullback, so we'll go back to this Broadcom example. Avago, used to be Avago. I call it Avago because the symbol's still AVGO. That's kind of clever though. The two companies merge and they use one company's name and the other company's symbol, which only serves to confuse me. But in any case, you get this pullback. The volume dries up here. I consider a Voodoo pullback to be volume that's minus 35% below average volume or less. So, the lower the better. So minus 60%, minus 70 is an extreme Voodoo type of move. But you buy the pullback here and it gets you in at a better price. You're filling the gap here and riding the stock from there. So I look for those types of pullbacks. So the Voodoo pullback is one of my favorite ways to buy, or the tight Voodoo action along the moving average like you saw with the Weibo or Weibo, I'm not sure how you pronounce that. Max linear, here's another example of you have a gap up move here on big volume, see that right here, and you pull into the 50-day line, I'm sorry, right here, this 50-day line, you pull in right here and the volume dries up right here and you buy it right there. Now a lot of times when you're buying these Voodoo pullbacks, you'll see the setup, but the market may be pulling in, and so you may be scared away. But you sort of have to grit your teeth and buy the stock on the basis of the setup, because what you know here is that if it fails to hold the 50-day line, if it pulls back on light volume and it closes just above the 50-day line, you can buy it there and maybe use the low of this range here as a tight stop, or the 20-day moving average as a tight stop if it doesn't work. So a lot of times the market is not really looking all that wonderful when you see these pullbacks, and that's generally when stocks will pull back, they'll pull back with the market. You want to step in and just buy it on the basis of the Voodoo pullback and not be afraid, as long as you understand that you have a quick out in terms of a tight stop. So in that case with Max Linear, it would have been the 20-day line or the 50-day line. So here you have Silicon Motion on a breakout. Now notice the breakout fails and it pulls in to the 10-day moving average on extremely light volume and then takes off from there. So, a lot of people would be scared away. They'd look at this, oh, it's a failed breakout, but it breaks out, pulls in just a hair. You get extreme volume dry up right here on the pullback, and you buy that. That's one of my favorite ways to buy. And even after a breakout, I look for a pullback, like with the Broadcom Avago. That's one example, and this is another good example. Undercut and rally setups. Now these are all the stocks, the stock setups or the long setups coming off of lows of patterns. So you get undercut and rally setups. You get Wyckoff Spring, very similar, just different terminologies, and Livermore's Shakeout-Plus-Three. So these bottom buying things are based on Livermore's work, Wyckoff's work, and then my own spin on it as an undercut and rally setup. And then there are also short sale setup inversions, and basically those are things that I've derived from my work on the short side. So what I've learned to understand about short sale target stocks is that when they break down, they'll eventually find places where they bottom, like they may undercut a prior low. And you can read our most recent book, Short Selling with the O'Neill Disciples, where I go into great detail about this. How a stock that's breaking down will have a nice breakdown, a shortable trend that you can make a lot of money on the short side, and then eventually it bottoms and we'll have a very sharp rally to the upside. And you'll notice a lot of stocks, as they're coming down within overall downtrends, at certain points in the downtrend, they'll have these very sharp upside moves. And those sometimes can be playable as a long setup for swing trading purposes. So quick examples here. Let's look at, we'll look at the ugly duckling principle here on this sort of shakeout type move. Look at Fabrinet. It's in a nice base here. Breaks apart, hits the 50-day on heavy volume, so that looks like death. But it rallies back above the 10-day line, and then it pulls back into the 10-day line on very light volume. So there's a combination of things here. There's a shakeout. So $26 stock, maybe you use a Shakeout-Plus-Two. The way I would handle it though is once it got back above these lows or above the moving averages here, then I would watch a pullback or a retest of the low. That's a Wyckoфfian retest is what I like to call it. And it'll come in on light volume, and that's where I'll look to buy it. So if you get a shakeout, this is sort of what I call an ugly duckling type move, where something looks incredibly ugly and it scares you away, but it actually turns into something viable if you keep an open mind. and understand how these work in this market where everything seems to fake you out. You know, it's a little bit of an Alice in Wonderland market where not everything is as it seems to be, and things change form very rapidly. So this would be an undercut and then a Bible set up on the white coffee and retest, which is sort of a combination of the spring and shakeout and a pullback, a Voodoo pullback. So I'm using a lot of different concepts here to come into these stocks. Let's look at, let's see, Palo Alto Networks is one of my favorite examples here, because here you have a stock that loves to undercut prior lows. So here you undercut these prior lows here, and you rally, and that might be a tradable move, very short one, coming from about 131 up to about well, you're getting a good 7-8%. Then it breaks down, undercuts this low, and then goes on to a long rally up to the 50-day line. Now, see, this is pretty typical action for a stock that you might consider a short sale target, but it's getting these nice rallies after the undercuts. And if you play them, the way I'll play them is once it rallies above the low, I'll use that as my stop. So once it gets above, I'll buy into it and then just use it as my stop. Generally, if they're going to work, they will hold that low. You could add another 1% if you wanted to. Now, if you look at most recently, after they announced earnings a couple of weeks ago, I think it was, they broke down hard, but it just barely undercut this low here, and it's turned and rallied, and that's about another 8% move. So there's all these moves on these undercut and rallies. You could even look at this one here, this move, even though it didn't undercut this low here did not undercut this low here. It did pull back on really light volume, so it's a retest on light volume, which is what I call a Wyckoffean retest. I don't know if that's necessarily accurate with respect to Wyckoff specific work, but I just call it that because it's that sort of a low. The basic idea is that it's a test for supply as it pushes towards a low, and it's not finding any sellers, and so what happens is it tests a low and turns back to the upside. So those are examples of things that I'll use on the along the lows of a pattern as the stock is undercutting. Now here's another example. See, Apple undercuts the lows here and it turns back up to the upside, so that's an undercut and rally. I guess you could call it a spring and a shakeout plus X, whatever. I prefer, my rule is much better, just using a move back up above the lows to buy and then using that as your stop. So the closer you can buy to the lows as it pushes back up, the tighter you can keep your stop. But in this market, this setup tends to work. Now, I don't know if it's going to continue to work because we may get into a better trend following type market. Who knows? I mean, now that those who claim to know suddenly are jumping on the swing trading bandwagon, maybe that means that it won't be as effective. So I don't know. We'll find out, won't we? And then here's another undercut. You see Alaska Air, and this is when the airlines were all bottoming together, and you see the undercut. So again, once it undercuts, you can use this low. Once it gets back above that low, you can come after the stock and use that as your stop. So around 64.18 on the low here would have been your entry point, and then using that as your trailing stop. This also had some pocket pivots on the way up. You might notice that if you're watching here. I think there's a pocket pivot here. I'm not sure. One of these moves could be considered a pocket pivot since they're all up days. And so you're getting these pocket pivots here, which also could be considered roundabout pocket pivots. But notice how once it gets up to the highs, boom, that's all she wrote. So if you're waiting around for a breakout, you're not going to get it. You're better off trying to do the shakeout. And this is actually more of a Livermorian pivotal point or a reversal pivotal point, where he talked about the Shakeout-Plus-Three as if the stock made a low and then went 3 points past that low at least. So in this case, it doesn't quite get there, but it's close. And it turns back above that by 3 points, you could buy it back. That's a lot of gobbledygook to me. I think you can just use buy this on the basis of the undercut, and then use that prior low as your guide for stop once it moves back above that low. So, to me, that's pretty straightforward. and less trying to figure out, oh, do I use 3 points or 4 points or 5 points? That's all, to me, that's all unsubstantiated bunk. Workday is a short sale inversion. I've noticed that when stocks, a lot of stocks that are breaking down, and I'm working on the short side, and Workday was one of these, when they turn, they'll have an earnings report sometimes, and the thing will gap up. And if it's pushing up to a moving average, like Workday was on the day after earnings, it was pushing right into this 50-day moving average here. And I was actually trying to short the stock, but I could feel that the bid in this thing was very strong. Every time I would try to pull back a little bit, the buyers would come back in and push it. So what do? Well, if you can sense that in sort of Livermorian fashion, you can sense that there's a strong bid and a lot of buying demand coming into the stock every time it pulls down or pulls back a little bit on an intraday basis. You can come in and just buy it. And I buy it right there at the 50-day line, and boom, that's around 66, and you've got, within 3-4 days, you've got a 10% plus move, easy. So, I would say maybe 12, 13, 14% in just a few days. So I'll play those types of moves too. It's a little more complicated, it requires some judgment. But if you've shorted as much as I have, and you've had your head handed to you as many times as I have in the past, you learn fast when something is pushing against you, and when you're much better off just flipping long and going with the flow. And in this case, that's what I did. And those are what I call short sale inversions. So, I've covered pretty much all of the types of buy setups. If you're interested in finding more, or learning more rather, I would suggest these books, following resources we'll call them. The first you should read is A Complete Guide to Volume Price Analysis by Anna Cooling. Very good book, and Anna Cooling's work is also embedded in the HGS Investor Software program that I like to use these days. I don't use MarketSmith or Wanda anymore. I use HGS Investor Software, and there are lots of canned screens and chart views and whatnot that can be accessed on HGS Investor Software, and Anna Cooling's Volume Price Analysis, or VPA, is on there. Next, you should read Trades About to Happen by David H. Weiss. This is a very good, but very detailed and very thick, shall we say. You're gonna be slogging through it, but the information is very good in terms of covering all the different Wyckoff types of setups and technicals and whatnot. So that's the second book you should read. And then finally, Price Action Breakdown, which is a real interesting treatise on swing trading, price action, and understanding ranges and when demand and supply are out of balance or in balance and whatnot. And I think it's very important. These are all very important concepts rather for swing trading. So those are the 3 books I recommend reading. And I would not, don't get sucked into buying some expensive product. I think spend a little time studying what I've talked about here, but also read some of these books. And if you're really driven to, you can go to GilmoreReport.com, or you can go to virtuousselfishinvesting.com. If you're real lazy about typing out long URLs, you can just shorten that to selfishinvesting.com, because we talk about a lot of the swing trading stuff, and it's all included in our basic service, which I think for Gilmore Report is $50 a month, and Selfish Investing $60 a month, a lot cheaper if you do a quarterly plan. But we're just here to educate people without creating dependence on our products. And the whole idea of people learning to trade for themselves and to make their own decisions is what I find attractive about trying to teach people how to trade, rather than making them dependent on my incredible guru-like wisdom, which I think is a bunch of baloney, and anybody who's trying to sell you on that sort of stuff is full of baloney as well. So on that note, thanks for sitting through this presentation. I hope it was helpful, and good luck trading.